Hey guys, what is up? It's Arthur here and welcome to this video in which we will look at Nvidia's growth potential and fundamentals as it was requested by you guys in the comments. So if you have any other company you want to look at, leave a comment down below and we will sort it out. So in this video, we're going to look at Nvidia, and I just want to show you how big of a run up this company has had in the past 3 years, going from $12 all the way up to like 144. So just a 10 bagger in the last 3 years. And if we look at all the way back, it looks like the stock is on the market from like 99 and it was a low of like $0.1, like 10 cents, going to more than 100. So that's like 1,000 bagger right here, which is absolutely insane. But we want to make sure that this growth is here to stay so that this can continue happening. And so the way we want to look at that is through fundamentals. So first things first, what does Nvidia do? If you don't know, Nvidia designs and manufactures computer graphic processors, chipsets, and related multimedia software. It has a graphics processing unit, GPU, and compute and networking segment. They have a lot of their own software and applications and solutions for running and developing these systems. Also supply data centers, computing, Nvidia AI Enterprise, and other software. So like a great host of tools that people can use and companies can use to run all their AI matters. Stock is down in recent times, but it's still up in the past 1 year. It is a very volatile company. Beta of 1.84 means that for the average market movements, in Nvidia's case, it is multiplied by this number. So the ups are that much higher and the lows are that much lower. So it is a volatile company, but let's see what the fundamentals say. So first things first, 2.75 trillion market cap, huge company. We're going to go into financials and look at whether their sales and revenue have grown, which is the very first line in the income statement. And it comes as no surprise that with the recent AI boom and this being a prime chip manufacturer, we went from almost 11 billion to 61 billion. That's a little less than 6x, which is absolutely insane. That was something clicked in 2023 as we did like a 2.5x almost. That is incredible. And we want to make sure that this is the things, and these are the kinds of things that will stay around, because that's when you can justify paying a higher price for this company. And I'm not talking about share price because that's misleading. We want in these cases we mainly refer to the PE ratio and the price to free cash flow, which we will cover, so just bear with me here. Also, working our way down, we can check net income, which is going to be our second. It's also a check mark like the first one because there has been immense growth, going from 2.8 billion to 29.8 billion almost. That's again a 10x in just 5 years, which is absolutely incredible. And so that is always great to see. Now that you know the net income, in these checklist that I prepared, this 10-item checklist, based on which we screen companies, so to say, you can calculate the average of this net income, and that gives us 10.2 billion that you can see in the top right of the second card. And you can use that to go back and take the $2.75 trillion market valuation for the company. This is what the company is worth. This is how much you would have to pay if you want to own the whole of Nvidia. If you divide that by the average net income they earn in a year, 10.2 billions, you will get an atrocious PE of 270, which I'll be the first one you cannot really take into account here, because this takes this considers a 5-year average of net income, which, considering Nvidia's recent exponential growth, taking the average really brings this number down. And comparing it to the current high market valuation, the market cap, which has this growth factored in, this creates a discrepancy here, and that's why you can't really do this, or why you should not rely on this, although it's an X. What you can do is go to the income statement, just like we did, but instead of annual, we go quarterly, and we'll get the most recent 1 year, which I'm just going to bring out a calculator and let you know these are the rows that we are going to sum, because we're going from left to right, and these are the 4 most recent quarters. So adding these up, 14.88 billion, 16.6 billion, 19.31 billion, and 22.09 billion, that's 72.88 billion. And now if you take the market cap, which was 2,750 billion, divide that by the most recent earnings, that gives you a PE ratio of 37.73. So that's like a more respectable, manageable number, although you'd still want this to be below 20 for you to make sure that you are sort of already starting from a good position. But if a company has growth and has growing margins, for example, that's when you can start to look into paying a higher PE ratio or price to free cash flow ratio, but it always needs more research. So let's move on. We want to, in normal cases where we're not talking necessarily about growth companies, we want to compare this number to the industry median, which I created because I want you to get into the habit to look at other companies and see how their business model works, what is the average price that people are paying on the market for these companies. And that, in the case of Nvidia, is 24.6. Now we can compare that to the newly calculated most recent year, which was 37.7. Okay, so it's still more expensive, so that's an X. It's still more expensive than competitors. So you have to go in, dig deep, and see why this commands such a high premium for it. Now the fifth metric is called 5-year return on invested capital. This shows you that if the company gets money put into it, like $1 through debt or issuing shares, how much money it is going to generate on every dollar that gets put into this company, right? In Nvidia's case, this is 35.5% that I calculated, which is a huge number. The market average is around 9-10%. We want this to be above 10%, so this is a massive check mark, because 10% just is nice and round, and we want to keep it simple. So 35.5%. This means that, again, if $1 gets put into this company, they're going to make 35.5 cents on every dollar. This is very good because they can get sort of exponential returns when they invest in their business compared to other companies who are doing the market average of 9 to 10%. And also, companies that have a high return on invested capital tends to be the ones that have sort of a sticking power and have some kind of moat around them, some sort of competitive advantage over the others, which you still have to make sure that is here to stay, because competitors can come up and that very position that Nvidia might be in now can get threatened. Now, the next thing we want to make sure is that the number of outstanding shares is decreasing. So as time goes on, you get more and more of the profit that they are distributing. This is in the income statement where they talk about how many ways they have to distribute this income. We're actually going to go back to the annual reports because we want to take the 5-year timeline here. And we went from 24.7 billion. It's actually up at 24.9 billion, which is just almost 1% of an increase. It's not a huge one. We could give them a break on this. I would not be surprised if they issued a lot more shares because of how, we cannot say if it's expensive or not because that's very subjective and comes down to everyone's assumptions. But given that they are not cheap, definitely not cheap if you take only a snapshot of their financial statements and the current time, not factoring in the growth, in that case, they are not cheap, and I would not be surprised if companies in that position would start issuing shares so they can get more money on those issued shares. And when they deem that the company is sort of cheap and undervalued, they would start buying this back. This is sort of relatively stable over this 5-year period. It's an X because I want to see this number going down, but it's not a huge X, and it could be a lot worse. But still, a declining tendency would be very nice to see here, especially with such a high growth company. Now, the next metric I look at is that we want the 5-year long-term liabilities, so the debt that they have, which is going to be in the balance sheet. We want the growth of that to be lower than the amount by which, the percentage by which their revenue grew. So that would tell you whether they used debt to grow their business or some other clever management. Now, long-term liabilities, which are sort of debts and obligations that are due in more than 1 year, are not going to be on most balance sheets. So what you can do is you take total liabilities, which takes into all payables and debts, and you deduct the total current liabilities, which are the ones that are within 1 year, that are due within 1 year. So you are left with basically this, which is the total long-term liabilities. Now, the growth of that, I can show you, is going to be 263, basically 264%. A huge increase in long-term liabilities. I can show you my stock sheet, and I have these balance sheets pulled in, and you can see the calculation here. Total liabilities minus total current liabilities gives you total long-term liabilities, which is up 264% compared to what you can see on the first card, revenue, which is up 457%, which is still higher. So even though they took on a lot of debt, they were still able to grow their business by a larger margin, which is great to see. So that's a check mark. Taking on a lot of debt is not so surprising considering the immense growth that they have been going through. So that's okay. We just want to make sure that they make more money than the debt that they take on. And that is the case here. So that's great to see. We're going to go to cash flow and talk about free cash flow, basically the money that the company has left over after the money comes out and the money that they pay out. Now, free cash flow is always net operating cash flow plus the minus amount of capital expenditures. You would calculate this for all years. I also average this up to see and smoothen out the bumps, but in such a high growth company, this is not going to be that much applicable, I think. However, on the very bottom, on MarketWatch website at least, you have a sum line of the free cash flow. So you can check that, and you can see that 5-year free cash flow is up from 4.27 billion up to 27 billion. Insane 532%, which is more than a 6x, is absolutely incredible. Look at the last 3 years even. That is immense growth, and that is very difficult to factor in, and that's why you would have to dig in deep and look at the competition, how the AI space is evolving, just so you can get a better understanding of how likely these growth numbers are here to stay. Because if this company grows at like the rate of like 3xing the revenue every 3 years, that is going to be insane. And we don't know, you cannot grow at these rates forever. We know the AI is probably here to stay, how much more it can grow, how many more users it can get, and whether we're going to have enough data to teach it, whether they're going to find new ways to come up with better results, is still a question that needs to be answered, and you have to make an assumption of that, which is going to reflect on how likely these numbers, growth numbers, are here to stay. Now, we can also calculate the 5-year average free cash flow from this, that you can also see calculated on the top right of the card, which is $9.58 billion. And you can take that and check how much time the company needs to pay off that long-term liability that we calculated. And you would only look at the very last year because that is the snapshot of the balance sheet. That's what's inside the company, what they have versus how they can afford that. And so you just look at the most recent year, which is $12.12 billion. In an average year, they make $9.5 billion in cash. So it only takes them 1.26 years to pay down all their debt and be completely debt-free, which is a fantastic situation for a company to be in. Gives them a lot of, relaxed mind and a very laid-back approach. They're not really burdened by all this debt. So that is a great check mark there. And we can also compare the free cash flow number to their price, the market cap that they are asking for the price for the company. Again, we would go into the quarterly just to get the most recent yearly figure because it has been so rapidly changing. So I'm again gonna just add this up quickly, which is gonna be the 4 most recent years: 14.98 billion, 13.51, 16.81, and 15.55, which is an average of 60.85. We're gonna go back and grab the market cap so we can compare how many years at the current values it would take you to make back your investment. So 2,550 billions, which is 2.75 trillion. You're gonna divide that by the free cash flow, so you get your price to free cash flow number, which was price to free cash flow was 60.85, and that gives you a price to free cash ratio of 45.19. This is still an X using my usual method, but I would not rely on that in case of high growth companies like Nvidia is, but I would more or so rely on this 45.19 that we calculated using the most recent quarters, so adding up basically computing the most recent year that they did. The reason why you don't look at the annual statements for that is because that is for closed financial years, and if you look at the quarterly ones, you have more up-to-date, like a mid-year data in there. So a 45 price to free cash flow ratio is still high. We again would like this to be under 20, because if you, let's say, buy a company or a share for that matter at a price to free cash flow ratio of 20, that means if everything stays the same, the company keeps on generating the same amount of free cash flow every year, it's going to take your money 20 years in the company to earn back itself. And it's going to do it in ways that the company can use free cash flow for. There are 5 ways a company can use free cash flow for. They can issue dividends, they can buy back shares, they can buy other companies, acquire them, and they can pay down debt or reinvest in the business. This is what your money is going to do in a company if you buy shares, and you want to know how much time it takes for your money to make itself back, and then you can start profiting on that. Now, compared to 20 years, if the most recent free cash flow number is the one that is going to stay going forward without any growth, it's going to take you 45 years, compared to which there are, of course, probably better investment opportunities and better share buys. But you got to look at how likely this growth is, how much this growth is likely to stay. And also I would highlight the very high return on invested capital that they have, 35.5%. That is among the highest I have seen. Probably Apple has highest somewhere in the 40s or around 40. This is a very, very high number compared. That's like 3.5 times the market average, almost 4. So that is very, very high and gives them a big competitive advantage. And you just got to dig deeper and see how Nvidia is going to stay here, because if this growth is likely to continue, paying a 45 price to free cash flow might not be a terrible idea. I'm not saying you should buy this, but do more research on this. Find a model where you can model the coming free cash flows. There is one that is called discounted cash flow model. I'm working on one so I can show this to you, and we can put a price on a company using my assumptions. So you can copy that calculation and use your assumptions in there to see what theoretical price a company would be worth, and then you can do more research on that and come up with what you want to do with this stock going forward. That's it for this video. Let me know if you have any questions. I'm happy to talk about it. Bring your ideas and thoughts about Nvidia. Is it likely to stay? What kind of competition is coming at Nvidia? This is a very interesting stock to look at. So let me know what you guys think. I'm very interested in hearing that. Thank you for your time, and I hope to see you in another video. Take care. Bye.